Proud supporters of Africa this week. Engine, with us, you are number one.
In the show this week, we look at the pitfalls facing Africa's listed subsidiaries of global companies. We also look at property trends and trade in GM foods in East Africa, as well as a Mauritian trade exhibition underway in South Africa this week. Complex governance risk faces minority shareholders when they invest in the listed subsidiaries of multinational companies, where the parent company typically has majority ownership and control of its local subsidiary. Greg Barker, head of investment research at Sustainable Capital, helped navigate through the minefield.
What we found in our research was if you take the top 100 companies in Africa, excluding South Africa, of those, 71% of the companies have controlling majority shareholders, and 28% of that is multinational companies. Another 28% is family owned and controlled businesses, and 14% is government controlled companies. Now what we're saying is basically investors as minority shareholders in listed companies in Africa, ex-South Africa, need to have their eyes wide open to the corporate governance risks associated with that. And contrary to sort of traditional wisdom, we would sort of put forward the notion that often a family-owned and controlled business with intergenerational time horizon and where the senior management have physical shareholdings in that business may present a lower governance risk to shareholders than perhaps multinational companies with management that is employed at the holding company level who have little interest in growing the local share price.
So net, Greg, would you say that the relationship is beneficial to Africa, and to what extent, to South Africans, and to what extent is the country disadvantaged, if you like, versus a company that is controlled from, say, South Africa?
I think you need to look at it on a company-specific basis. It varies quite dramatically between companies. For example, some holding companies are charging so-called management service or brand fees of over 2% of their revenue lines, where in a low margin industry that can represent up to 24% of the profit before tax. So that's effectively amounts to a tax on minority shareholders that's being taken out before the earnings and dividend level. So you really need to look at it on a company-specific basis. It varies a lot from company to company and in different countries. But we take, as long-term investors, quite a careful look at the corporate governance practices of the different companies and integrate that into our investment valuation and decision making, because through either corporate actions or transfer pricing or capital allocation, there can be quite material conflicts of interests, and you need to ask yourself what vested interest does that holding or majority controlling shareholder have in looking after minority shareholder interests.
Yeah. Now, if you look at the three types that you have given us here, the three types of investors that we have, so you have those companies that are controlled by multinationals, and then you have the family-controlled companies, and then those that are controlled by governments. Who would you say, if you like, are the worst offenders?
I think it's often the multinationals. That's where you've got a multinational company, and you're talking about big name multinational companies that have a subsidiary in a local African country which is listed on the stock exchange, but the holding company typically owns more than 50% of that underlying subsidiary. Now these are mostly US and European holding companies. What we find often is that the senior management team of the company is employed at the holding company level. Also, share-based incentives, for example, are based not on the share price of the local subsidiary, but on the group company. And we would question firstly, what influence that CEO or CFO of that local subsidiary has over the entire group. And secondly, how does that align with the interests of minority shareholders who have, if they're just investing in the African subsidiary, have no interest in the group's performance. They're interested in how that local subsidiary performs.
Yeah, now that's an important
that's
story.
the challenge with the
Yeah.
That's a challenge with the multinationals.
Absolutely, it's a big challenge, and we saw it as well, I think, in the last year or so with Anglo-American Platinum, where you have the chief executive of Anglo-American, the global company, sitting on the board of the local subsidiary and becoming de facto the executive chairman. But what can shareholders do apart from raising these issues at annual general meetings?
I think, well, I can comment on our behalf. What we see it as part of our fiduciary duty as long-term investors to be engaging with the companies on these issues. And for example, something like what is required for a special resolution and what is the percentage required to pass a special resolution. I mean, for example, in corporate actions, let's say you've got a controlling shareholder multinational, and you've had a period, let's say like 2008, where all share prices have come off. That multinational, as a control of the board and got a controlling shareholder, can come into minority shareholders and say, look, we're going to delist this company, we're offering you this percentage over the volume-weighted average price of the last 90 days. But that might be absolutely irrelevant to a long-term investor who already recognizes that the fair value of the company could be worth 3 or 4 times what the share price is. And the same applies to transfer pricing. I think what the key thing is that there are certainly positive aspects like knowledge transfer, brand, access to markets, intellectual capital that these holding companies bring. The problem we have is that we see very few instances where the fee that is being charged is actually at an arm's length basis and adequately reflects the economic value. So often the fee charged is a lot higher than what you might acquire those same services for at an arm's length basis.